Contrasting Viewpoints with Ray Sclafani and Mark Hurley.
Ray has been one of the leading consultants in the financial services industry for many years, and Mark has annoyed countless people throughout the wealth management industry over the last 25 years with the white papers he has written. Today, they are going to provide their insights into what is really going on in the industry, some of the more absurd things they've seen, and also for anyone in this industry, some issues they should be thinking about as they try to build their business.
And welcome back to Contrasting Viewpoints, the podcast where we challenge conventional wisdom and unpack the biggest shifts shaping the future of wealth management. I'm Ray Sclafani, your co-host, along with Mark Hurley. Mark, it's always good to be back together with you again.
It's great to be with you too.
And wow, do we have a lot to get into today. So quick overview. In today's episode, we're going to dig into a fresh wave of headlines from SEI's $527 million majority stake of Stratos Wealth and what it signals for aggregator evolution, to Cerulli's latest research confirming that tax planning is no longer a nice-to-have, but a must-have skill for any advisor serious about growth. We're going to share our take on how to really win with centers of influence. And yes, another "you've got to be kidding me" moment as Vanguard makes headlines for what might be the most ironic pivot in recent memory. Our main topic today, we're going to ask the big question 18 months after Mark published Welcome to the Jungle, the white paper really framing what the future of the industry looks like. Where are we really? Is the predicted consolidation unfolding as expected? What's the hype? What's reality? And what should independent firm leaders actually be doing next? So Mark, you want to get into it?
Let's go.
All right, so let's go with SEI first. SEI, for those that are following along, has agreed to acquire a majority stake in Stratos Wealth Holdings, marking a significant move in wealth management, aiming at helping advisors scale their businesses. Under the terms of the agreement, SEI is going to pay approximately $527 million in cash for 57.5% of a newly formed entity that will own Stratos operating businesses. The remaining 42.5% will stay with certain legacy Stratos equity holders, with provisions in place that could eventually give SEI full ownership. So, Mark, what's your take here?
Well, look, I think this will be a kind of a milestone in the evolution of the industry, not because of the size or anything like that. It's because what SEI brings is it takes what is now a very, very successful, incredibly effective aggregator and integrates the business. I mean, SEI brings to the table technology, custody, operations, and asset management. And one of the things that we argued when we wrote the paper was everyone thinks of aggregators as just buying up different wealth managers and in certain cases integrating them and putting a brand on them. One of the things we've always argued is ultimately there's going to be a shift that's going to occur. Number one, once you bought a firm, you really don't own anything in the classic sense of like tangible assets. What you have are existing relationships with clients. That's really the only thing of value. And we talked about last month how Mercer, for example, is now giving out substantial amounts of equity to many, many, many people in the organization, because the objective is to effectively share the economics to make this a compelling thing to keep your best people so you can keep
got to retain the talent, right?
Retain the talent, keep growing the business. Well, as you do that, that reduces the economics of the aggregator. And the only way to offset that is to develop other lines of revenue. In other words, you start to build out a fully integrated business. So you're getting paid for custody. You're getting paid for certain types of investment management. You're getting paid for all kinds of things as opposed to wealth management in order to make the economics work. And you increasingly look like a firm called Schwab or a firm like Fidelity. This is the first step in that direction. And one of the things we argued in the paper was at some point, not only will these guys do it, they're going to have to do it to make the economics. And so what you'll wind up, these giant firms, with $500 billion to $1 trillion of assets under management, they're basically going to be a landscape of competitors of 40 or 50 Schwabs type organizations competing with each other.
Yeah, that's a big move for Stratos, and it's a genius move by Stratos' CEO, Jeff Concepcion. They reported AUA coming in at $36.1 billion, including $14.7 billion of brokerage, $21 billion of AUA, yet the firm itself reported $37 billion of administered assets, and other reports placed the firm's AUM in the region of $36.5 billion. So familiar with a deal less than half an AUM at valuation under $1 billion likely has to do with revenue arrangements with firms, like when you think about referrals and you think about where some of this revenue is coming from, what does it look like for the referral stream for some of these custodians looking at Stratos today?
Yeah, and I think the statistics we had in the paper, I think, were that Schwab spends about $580 million a year on marketing. Incredible machine, incredible organization. They get so many people coming to the branches. They make 14,000 referrals out from their branches. All these big firms are going to have to build similar brands to be competitive. In other words, they're going to have to develop these other lines of revenue, which will put them in direct competition with Schwab and Fidelity. But they're going to have to figure out other ways to draw people directly to them. Otherwise, they're going to have a hard time capturing clients. Mm-hmm. This is the great challenge if you're the CEO of one of these aggregators. Again, what I found fascinating about the SEI deal is it's happening quicker than I would have thought. We would have guessed these organizations would have gotten larger before you saw the integration process. But the fact that they have these arrangements with different revenues with different firms, this is a very smart deal that Concepcion's put together, because now the combined organization will have the ability to capture additional revenue streams.
Well, yeah, that's right.
Make the business much, much more valuable.
Yeah, this is great. Okay, good. Let's move on to the second story. In 2024, Jerry Prince and Russ Allen Prince surveyed more than 400 accountants and attorneys, and they determined the best practices for wealth managers in building their practice through centers of influence referrals. The first and foremost foundational requirement is personal integrity, a factor considered essentially by 99.8% of the COIs, accountants and attorneys. I don't know who the 0.2% is. Chemistry is the criteria regarded as very or extremely important by 80% of the COIs. So in addition to personal integrity and chemistry, technical expertise serves as a crucial foundation. Not surprising, 85% of those reported focusing on strong technical expertise in deciding who to work with. All this information sort of leads to this critical factor around where COIs fit into the business for wealth managers. I was just curious what you thought about this article. Why did you want to pick this article to talk about with the group?
Well, I thought the most revelatory part of the article, if you dig down through some of the statistics they have in there, is that what the most successful people in terms of getting COIs to refer stuff to them have developed capabilities to help the COIs with their businesses. We always think of this as reciprocal referrals or something like that, but that's not it. What they found is if those organizations that could bring additional value added in the form of expertise or technology or something like that can help the referral source be more successful in what they're doing, invariably that is the most dominating factor that they decide on whether to send referrals out to parties. So if you're thinking about building a referral network, a COI network, the starting point should be you should sit back and think, okay, what can I do to help this law firm, this accountant, whatever type of business is going to make referrals to be more successful? What is their business model? How do they get clients? How can I play a role in assisting them in doing that?
Okay, so let me add a little color here, because in our coaching program at ClientWise, we've studied this a great deal. And I write about this in my first book, You've Been Framed, that what I've learned about the best in the business is they're not focused on picking CPAs, accountants only. They're also focused on business valuation specialists, business brokers, bankers, realtors, mortgage specialists. That's where the center of influence pool widens. That's number one. Number two that I've learned along the way is that the best wealth managers are identifying those other professionals that will complement the services of wealth management they're providing. In other words, they're not entering into a relationship of reciprocity. They're entering into a relationship where, hey, we're not going to be in the real estate business, but our clients need that help. We're not going to be in the business valuation specialist business, but oh, by the way, our clients who are selling businesses need that kind of partner. We're not going to be a banker. We may not be somebody entering into some of that philanthropic consultation, or they may. If they do it in-house, that's one thing. If they're going to outsource it, they identify the best in the business and they make them part of their process. I think what the study here coming out of Financial Advisor magazine and the work that the Princes did here was to identify exactly what you described, which is, I think, the third learning point, which is if a wealth manager is going to identify a partner to be an extension of their team, they have to think about how to help make those businesses better.
Yeah, I go away from symbiosis. I go away from reciprocity to symbiosis. How do you make it so that working with us is really good for their business and it's really good for our business? But to be sure, the survey makes it very clear that they first have to be comfortable that you're a safe choice. until you establish that referring clients to you is not going to create problems for them, they're not going to refer anything to you. But that's only a necessary but grossly insufficient condition for success. What will determine your success is your creativity in ways of finding ways that things that you do benefits their business as well as yours.
Okay, quick side note. I want to just get your take on this just because I know your past history here. Kiplinger's July Fed meeting, their updates and commentary, the theme here, the Fed's holding rates steady amid political and economic uncertainty. There's dissent inside the Fed duo, Fed Chair Powell's data-driven caution. I'm just curious because you've got some experience in the space. Any quick commentary around what you're reading in the press?
I was fortunate enough to serve with Jay Powell at Treasury. He is a person of incredible integrity and incredibly capable. Never believe anything you read about anything in this stuff in the media because this is normal politics. And, if I learned anything, I'd read the paper in the morning when they wrote about the agency when I was at Treasury that I was working with. And does anyone know anybody in the agency? Because I have no idea what they're talking about. That said, clearly, have an election coming up. The current administration would like to see rates cut sooner. There's a story today that a criminal referral was made on a Fed governor who purely allegedly, had borrowed money, taken loans, mortgages out almost simultaneously on two properties, each of which she's described as her primary residence, which is a federal felony to do that. So all this is getting a lot of scrutiny is coming up. There's a lot of fight going on. Again, just step back and relax. The fundamental basic thing here is an administration has a midterm election coming up. If they want rates starting to be cut right now so the economy's booming going into it. The Fed is concerned about inflation. There's a natural back and forth, healthy tension between the two. I think ultimately everything will be fine, but should be entertaining for anybody who writes about it.
Okay, very good. Let's jump to Cerulli's latest research that cutting clients' taxes is a must-have skill for advisors. 69% of retail investors consider it important for their advisor to help reduce their tax bill, with even more high net worth households placing a higher priority on tax savings. 79% say it's important with those over $5 million in assets. And Advisors in Transition, Challenges and Best Practices, which is the study Cerulli released, identify that tax assistance as a key consideration for advisors considering switching firms or who are involved in some kind of transaction, like moving to a firm that's going to provide a platform to help reduce the burden of the taxation for high net worth and ultra high net worth families is essential for most advisors. I also identified here in the study that the research found that in the second quarter of 2025, 38% of advisors expect tax transition assistance to be critical, compared with only 22% in 2021. So we're seeing here in the firms we coach at ClientWise a heightened awareness around making this a part of the practice. We're seeing firms acquire accountant firms, CPAs, bring that resource in-house, not just to prepare tax returns, but to be really front and point center around guiding families on how to reduce the burden of the taxes. Any quick commentary here?
Yeah, I mean, this is table stakes. It used to be a distinguishing item. Boy, the reason you want to hire us instead of these guys is we're really good at taxes. This is very quickly going to be, you're either going to be able to do this and have truly deep expertise, or you're just not going to be competitive. Think about for a second what's going on with states across the country. There are certain states that are facing phenomenally bad financial crises, and they're trying to get money any way they can. I'm sure we all saw about the Rhode Island property tax or the Taylor Swift tax, where they're jacking property taxes up on houses from non-residents, things like that. All this is going to mean is that unless you're able to help your client think about and plan for these issues, they're going to wonder what they're fully paying for, because investment management that's important, but that's really only a small subset of the real package of what you have to provide. Now, the good news is, and we're going to talk about this next month, the speaker talking on this, there are now artificial intelligence software packages. They can make it very easy for firms to get much further up the curve on this and do a much better job for their clients. And we'll have a speaker joining us for our podcast next month.
All right, terrific. That's a good preview. Let's go to one of my favorite segments in our podcast. You've got to be kidding me. By the way, Mark, I was at a conference recently and somebody came up to me and said, Ray Sclafani, you've got to be kidding me. And I looked at him, kind of paused, like, what is he talking about? He goes, the podcast, man, the podcast. Anyway, so I thought that was pretty funny. This is yet another you've got to be kidding me out of RIA Biz. Brooke's done it again. Ready to really take on Schwab and Merrill Lynch, Vanguard quantifies meaningful value that financial advisors deliver beyond portfolio performance in code shift. According to a recent study here by RIA Biz, Vanguard has apparently experienced some sort of spiritual awakening and now wants the world to know that financial advisors offer meaningful value beyond portfolio performance. And they're not just saying it, they've quantified it. Enlighten us through the data, I suppose.
Well, let me start with saying that I know there's things you can use for medicinal purposes out in California. I'm not sure they're always being used properly when I read articles like this. Look, Brooke and Co. utterly hate Vanguard. This is, of course, is like being against the American flag, motherhood, and apple pie, okay? This is one of the greatest organizations for investors in the history of the Republic. And so he talks about how, oh my God, John Bogle hated any investor, anybody giving investment advice, you should do it solely yourself. That's just pure baloney. What John Bogle thought was, and you got to go back to when the founding of Vanguard began, you used to have people selling 8-point load funds for people who were like junior college graduates who didn't know, they couldn't spell financial planning, much less do anything. The earliest and biggest clients of Vanguard historically have been the fee-only advisors. There's been a great relationship between them. So they put an article out saying that, Vanguard hired somebody from Fidelity, and therefore that has caused a spiritual awakening in the firm. Well, yeah, that'd be great, except if the fact that Vanguard already does $300 billion of financial advice assets. And at $300 billion, they're like one of the 3 or 4 biggest firms in the world.
That's amazing.
I mean, this is like, again, California is great. I'm sure they're having a lot of fun.
Okay, so let's move on to our main topic. There's been a debate 18 months later. I think it's interesting. So not that long ago, only a year and a half ago, you shook up the industry with your white paper, Welcome to the Jungle. It was pretty blunt, data-backed forecast about where the wealth management industry is headed. It was part wake-up call, part roadmap, and it didn't pull any punches. In fact, we'll publish a link in the show notes of this podcast. So if anybody wants to download and reread that and challenge you, that would be great. At the time, you predicted a decade of rapid consolidation, a reckoning for aggregators, a looming advisor shortage, and the rise of mega firms that would eventually look a lot more like Schwab, Fidelity, or even Merrill Lynch. You in the paper, you warned that the change would happen slowly, and then at all once, it would like big and swift, and that the firms who failed to adapt would be left behind. So today we're doing something rare. We're holding predictions accountable. You always like that.
Well, first off, you obviously don't have the ability to distinguish between blunt and sweet and sensitive, but
you were pretty blunt. I thought you were blunt.
Let's start.
Let's get back to the jungle. Let's talk about it.
All right. We started by saying, where's the industry at? And 20 months ago, the industry's waking up from this drunken party, this financial bacchanal, as we called it. The markets had just soared. Profits went up 4 to 6 times without even adding clients. Most of the industry was asleep. They had stopped marketing. 70% of the industry was shrinking, but for the market. You had this insane M&A frenzy because there was so much cheap money out there, and there was oceans of private equity money that was coming in. And as a consequence, most firms weren't actually adding bodies, and the industry was quickly evolving into an aging geriatric ward. Over half the industry is over 50, and 37% of the industry is planning to retire within 10 years. So we said, okay, what's going to happen? Now, for the record, we said, nothing's going to happen if the markets keep going to the moon, because nothing has to happen until the markets start acting normally. And the reason, of course, is that when you get one of these run-ups in the market, just turning the lights on is going to make your EBITDA go up substantially, because wealth management has operational leverage that's incredible. If a market goes up 10%, blended return, okay, well, how much does your cost go up with that? None. So your EBITDA is going up by 20% just for turning the lights on if you have, say, 50% gross margins.
What a heck of a business.
Okay, so boy, what a great seat to be sitting in. So we qualified it by that. That, you are correct, though. We argue, too, though, that is change is going to be gradual. And the prediction is over 10 to 15 years is what we've said. And we also say it's nonlinear, very slow, imperceptible at first. And then suddenly you wake up and go, my God, everyone's doing this stuff.
How did that all happen?
How'd that all happen? Now, what has happened? Well, we also said that there's this massive growth, organic growth opportunity. And we focused on the fact that there are 7 million more Americans between the ages of 45 and 60 and 60 and 75. Okay, they're all going to look for advice, very clearly.
And that's a demographic shift nobody can argue about.
And the whole game here is organic. M&A is something you use to complement organic. We said, what's going to be different? There's going to be an all-out battle for talent, not clients. The big firms actually are going to start acting like big firms. Big competitors in other industries, they don't simply allow little guys to compete with them on equal terms. Like in this space, it would be today, most firms say, I do A, B, C, D for X. And big guys say, I do A, B, C, D for X. And your distinguishing feature at that time was, oh, gee whiz, we're so much smarter. We're so much more charming than these other guys. In any other industry, big firms go, I'll do A, B, C, D, E, F, G, and H for X. And he does A, B, C, D. Which one do you want? And it forces pressure on little guys' margins in doing that. We also said that cyber is going to become an existential threat, is the only existential threat to your business. Everybody's going to be successful unless you screw up cyber. And we said M&A is going to continue, but the transaction is going to be much smaller and the prices are still going to be very full, but it's not going to be the same like we saw before, because most of the mid-sized guys have already been devoured. We did talk about the sovereigns coming in too. We said that at some point the PE firms are going to stop paying the sovereigns are going to stop paying PE firms all these management fees to do acquisitions they could do on their own, and that you're going to see some of these aggregators evolve into direct competitors with the custodians. So that was our forecast. And a big thing we talked about, what was the industry going to look like in 10 to 15 years? And we said is what you're going to wind up having is between 30 and 50 firms that are going to have $500 billion to $1 trillion. You're going to have about 200 to 500 firms that are going to be $5 billion to $100 billion. And there's going to be about 10,000 firms that are going to be generalists. The guys at the top are going to have businesses that are worth billions. The best place to be, the most fun, at least in my view, is to be a guy who owns one of these mid-sized firms that's a specialty firm. It's going to be very good at working with certain types of clients, with certain types of problems. And then everyone else, they're going to make a nice living, but the businesses are not, from an enterprise standpoint, are not going to be that valuable. But it's also a fine way to make a living too. All right, now, and we based that on the fact that if you look at the investment management industry, it's precisely the same evolution happened over the prior 25 years. What has happened? Well, biggest headline is I think the S&P is up 41.2% since we put the paper out. So not a lot has to change yet. I mean, this has been a great time to be sitting in this.
No force to make a move. The markets, all boats rise in a rising tide.
Right. Let's say a blended portfolio, over that same time frame is up, 25%? Right. Depending on what your operating margins are, your EBITDA have gone up pretty substantially.
You don't need to really find new clients at all.
Yeah. Although, according to BCG report, 78% of all growth has been through asset appreciation. So it hasn't been necessarily people grabbing lots of clients. The short answer is currently everyone is still a genius. Everybody in this industry is a genius, because if you just sit still and the market goes up, you're a genius. You can make lots more money. There also turns out to be even a bigger organic growth opportunity than we even realized when we wrote the paper. And that's where I think the real giant winner is going to be successful. There's a report out from McKinsey, where a very detailed survey, and what they found is that the population of households that potentially become advisory clients is growing much faster than the population itself. With families with $500,000 or more of investable assets, they're growing 4 to 5% a year, whereas the population in general is going 0.6%, and that doesn't count the shrinking caused by many immigrants going back, people that weren't undocumented immigrants returning back to their countries. That's actually caused the population to shrink a little. But the universe of potential clients has gone up. Far, far more importantly, their studies showed that over between 2018 and 2023, the percentage of people looking for holistic advice went up from about 29% to 52%. Meaning people want the type of advice that advisors provide. And even more importantly, that 80% of affluent households are willing to pay at least 50 basis points for human advice. And those willing to pay 1% premium grew by more than 50%. And these were made up mostly of people over $1 million in investable assets. Loosely translated, there is no greater business to be in right now than wealth management if you can execute on the organic growth side.
So we talked about this change will happen slowly, then suddenly, like with the markets up as big as they are, and there's been no need to force a change. What's the next domino you expect to see fall? And
phenomenal interview with Peter Maluk on COI.
Yeah,
everyone should go
awesome.
download. Peter is one of the smartest guys.
We'll put a show note in the show notes. We'll put a link.
Peter is one of the smartest guys in the industry, and Peter is who's a great guy. Sounding a little bit frustrated, I guess is the politest way to describe it, because he runs an extraordinarily great business, but he's having to compete with a couple things that are kind of out of control. One is PE firms with way, way too much money. Recent reports showed that the amount of uninvested PE capital of the last 18 months has gone from 1 trillion to 1.1 trillion. Yeah. So there's even more money looking for places to go. That is no place to go. I have a family member who's a senior partner at a very big PE firm and was telling me that it is not a happy time to be there. You can't sell anything because you need to get the management fees to pay, keep the lights on. And anything up for sale, there's like 80 people trying to throw too much money at it. You can't justify the pricing. And this is what's driving the insanity, the M&A. And Peter did disclose some interesting things to show how much money there's out there. He mentioned that he did his recap and gave no pref to the investors, which shows you how one, it's a great firm, but how much they want to get into his firm. And he says they're using almost no leverage, which shows you the people are just willing to write checks so they can put this money to work. But one of the things that's, he believes, he says, look, if we have a 2008, 2009 correction, the whole world changes very quickly. Economics change. I mean, people are just used to things going up. What if things start to go down? What if you start to lose clients, et cetera, et cetera? Again, none of us want that to happen, but that could be the trigger that you're asking about.
We also talked, I think it's important to point out, while the market's gone up so much, firms haven't had a change in a big way, but some of the forecasting about aggregators occurring sooner than expected has occurred. Sovereigns investing in Corient, oceans of money you just mentioned on PE. Now the SEI acquisition of Stratos Wealth, and Jeff Concepcion's leadership there has been extraordinary. Like, there have been a few things that have happened a little quicker in the last 18 months. What else comes to mind?
Well, we published the paper on December 5th, and I wanted to send fresh flowers to Marty Bicknell to say thank you, because on December 6th, he got sued for stealing talent. I'm working on a presentation, and some of the headlines are like, okay, lawsuits pile up as rivals accuse Mariner wealth advisors of stealing clients. Hightower accuses Washington RA of helping steal client info.
LPL had the thing with
Schwab accuses former rep of leaving a client. Okay, this is the world. The battle for talent has been engaged.
Yep.
There's a finite amount of talent. It takes a long time to become a very good wealth manager. And there's going to be a gap for a while until people can get people recruited and trained up.
The wirehouses have been fighting for talent back and forth for years. I mean, that's why the whole protocol thing.
This is why we said welcome to the jungle.
Right.
It's going from being a nice little genteel business we're all friends to people are fighting, and that's moving very quickly. The one big thing that surprised us a lot, though, was not surprised us, but we're seeing on the cyber side, clearly the number of attacks are exploding. You and I were talking before we started the podcast that we've had 7 different families in the last 2.5, 3 weeks show up on our doorstep looking for help. Now, we're in the business of preventing cyber breaches, but if anyone ever has a really adverse event, we'll drop what we're doing to help them. That's just our duty. And as a consequence, the sophistication and the complexity attacks using AI, using they're profiling people. They're taking advantage of cognitive psychology, similar to like behavioral finance. We're seeing guys with guns are starting to use
It's getting scary.
cyber
That's
tactics,
crazy.
creating physical risk to clients. I mean, we're teaching 10, 15 classes a week now to advisors and to their clients. But there's this race to kind of get up the curve on that. Now, the irony of it is, though, is the current administration, one of the first things they did is they wanted to reduce the regulatory burden on different businesses. So they withdrew the cyber rules. And so you're kind of in this middle, we're seeing this fascinating divergence. On one hand, many advisors are saying, well, look, the regulator's not going to be forcing me to do this, so I'm just going to kind of continue to what I do. And then suddenly we get these panic calls where someone has breached them and or breached the client, and now they're worried about what's going to happen to their business and or happen to their clients. And so the smarter guys are starting to get out ahead of this. They're starting to train their employees, more importantly, train their clients, because most of the risk is coming in through the clients, as opposed to where attacks are initiated through the client to get to the wealth manager.
Well, and I just want to emphasize that point, Mark, because I keep hearing advisors say, hey, we're good on cyber. We've got our cyber insurance. We've got our E&O insurance, and that's enough. And I check with my COO, and he or she tells me we're in good shape. We've got this buttoned up. But your point, what you just made, the training of employees and the training of clients and the consistency around the education, what you're telling me is this is an area that's moving really fast, and the bad guys are getting smarter and swifter about tracking. And so the more that leaders of these wealth advising firms can train team members and clients, they're going to be better off.
Yeah, we're talking about training the advisor how to advise the client.
Yes.
Everyone thinks of this as, okay, I know not to click on phishing emails, and I have rules of the firm that I follow. No. That's not the weak link.
That's not the point.
98, 99% of breaches are occurred by someone gets in through the client and uses the client as a vector to get to the wealth manager. And also, and we touched on this on an earlier podcast, no one can use your services if you're an advisor unless they use a custodian you've approved. And Brian Hamber and I worked on an article, and Brian points out in the article, he says, look, if it's an approved custodian, you have de facto recommended it. If you have recommended it as the sophisticated party in the relationship, you have a duty to inform the client about the risks. Well, guess what? The custodians have carved out in their agreements that they ain't taking this risk.
They're going to pass it on.
Even directly at fault, they're not getting their money back. Well, guess who's left? If something bad happens to go after.
Well, I would argue. Go ahead.
I want to say, even if you win the lawsuit, who cares? You want to see a headline in a local paper saying that you lost $2 million of somebody's money? I mean, if that happens, I think you have to start worrying about keeping your existing clients, much less being able to get new ones.
This is an area in Welcome to the Jungle that you pointed out was an issue, and I would say 18 months later, it's accelerated. It's become a bigger,
exploding.
You also indicated that you felt like the best days were still ahead for independents. How true is that today?
Oh, you're in the right spot. I like to tell people who are younger, I'll leave it at that. If you've got at least 10 to 15 years. Which would be a lot of
people for you.
Yes. Right. Thank you so much. At least 10 to 15 years of runway left in the industry. If you don't wind up making 8 figures doing this, it's because you didn't want to. If you're organized, you run a good business, you focus on organic growth, you're in the world's greatest pie eating contest. And it's phenomenal. You get a client and they pay you more over time for doing less work.
Well, I don't know that that's true. Business. I don't know that that's true. Advisors are working harder. I see
I'm not
today,
saying they aren't working, but
they're adding more services. They're adding more value. I'm going to disagree with what you just said.
Well, we'll put it this way. Most people don't make any money on the client in the first 18 months because they do so much work. Now, you can continue to do work for them, but it's not going to be as much as you do up front. But the assets appreciate over time.
Yeah.
So you get paid more.
I'm going to disagree with you. We're going to have to save that topic for another time because I see the world of retaining these really great clients as the next generation wealth inheritors comes up to plate. These advisors are working hard to retain and then continue to add value in a really heightened competitive marketplace. But more to come on that.
Yeah.
One other thing that I've heard you say, the bottom line is if you own an independent advisory firm, selling should be more driven by demographics than economics. What do you mean by that?
Look, this oversupply of private equity paying insane prices isn't going to end anytime soon. So the only reason why you ever need to sell a wealth management business because they just spray off cash flow. It's not like like you're having to raise capital to stay in business, like one of these tech startups where, every 3 months you do a funding raise. If you don't pull it off, you go out of business. Here, these things are ATMs throwing off $100 bills. The only real reason why that wealth management firms get sold typically is because the founders reach a certain age where they realize that the bargaining power as to who controls the economics is not tied to the legal ownership, but rather tied to the relationship and the sustainability. And that if the founders get too old, the next gen effectively will own the business without having to pay for it. That's what triggers transactions. So I put a paper out in 2015 or 2016, looked at the psychology of this, and that's really the inflection point. Any other industry, it'd be driven by economics. Oh my goodness, we're not big enough. And Peter was talking on his interview, and again, Peter's brilliant, so I'm not criticizing Peter. Oh, you're going to have to sell. They're going to have a choice. Everyone's going to sell because they're going to have to. Yeah, if we go through an extended bear market, maybe that happens. Okay, but beyond that, right now, there's just so much organic growth opportunity. If you're running a well-run firm, you're doing a good job for clients. This is your business. If you don't make your business 5 to 10x in the next 10 years, you really haven't executed well.
Yeah, really good. Mark, anything else you want to add before we begin to wrap up?
No, this is great.
Okay, super. So everybody, as we do wrap up today's episode, one thing, at least for me, is crystal clear. The jungle, Mark, that you warned us about isn't just a theory. It's a real like we're facing these issues, and the landscape is pretty dense with consolidation, lots of capital, complexity, and yes, opportunity. So for some, the path forward is going to be paved by scale, integration, and institutional influence. But for others, especially the fiercely independent, the way forward is about specialization, brand clarity, and embracing the human side of advice while attracting and retaining top talent. Mark, thanks for coming back and letting us test your own predictions and offer a brutally honest take on what's next.
Thanks a lot.
Well, everybody, whether you're leading a firm or building one or still deciding whether to run with the pack or clear your own trail, we hope this episode did spark some thinking. And as always, we welcome your thoughts, your questions, and of course, your contrasting viewpoints. Until next time, keep moving forward and stay sharp out there in the jungle. What do you say, Mark?
Look forward to next month.